Hello, everyone, and welcome to another episode of The Pragmatic Investor. Today, I am very excited to bring you this interview with Brad Thomas. He's the CEO of Wide Moat Research, which includes the brands iRate on Alpha, the Dividend Kings, and Wide Moat Research. He is also the editor of the Forbes Real Estate Investor. Brad is an incredibly prolific essay author, and he has over 108,000 followers. He is also the author of The Intelligent REIT Investor, and he's also writing a new book, REITs for Dummies, which will be perfect for me. Now, I really enjoyed this conversation with Brad. He has so much experience when it comes to real estate and investing in REITs. Today I got the chance to talk to him and ask him all sorts of questions about the real estate market, what kind of REIT sectors he's most excited about, which ones he's less excited about, how he thinks about REIT investing, how different investors should approach REITs, what are the fundamentals of investing in REITs, and so much more. I really enjoyed this conversation with Brad, and I hope you will too. If you haven't already, please go ahead and subscribe to the podcast. Share, like, tell your friends, tell your brother, tell your mother, and please enjoy. All right, Brad, thank you so much for coming on. I wanted to know, when is the other shoe going to drop? Because for the last few months, everyone's been talking about the real estate market and how it's going to crash, and it hasn't quite happened. What are your thoughts?
Well, that's a great question. And of course, media headlines today indicate that commercial real estate is just going to be an apocalypse. And of course, as I remind readers almost every day now, James, is you just cannot paint the entire real estate sector by one broad brush. You have to look at each individual property sector or subsector. And that's the great thing about investing in REITs, because you can be tactical in your investments and look and allocate capital to those sectors where you are most comfortable, or where you have the best risk tolerance for those property sectors. So there is absolutely no question that the office sector is continuing to have troubles. But even within the office sector, there are various subsectors that aren't as bad. For example, medical office buildings. I mean, just the word office itself sparks fear to many investors. But medical office buildings are very resilient properties, and with very resilient customers that have to go to the doctor and have to go on a regular basis. And so I think in terms of the broader market, there are some really terrific opportunities, especially in the REIT sector. And I know we'll get into it here in just a minute, and I can talk a little more detail about some of the sectors or some of the REITs that we really think are very attractive right now.
Awesome. So would you say then that you see a bit of a divergence maybe between commercial real estate being a little bit more in trouble, and then the more regular housing market, which we have seen hold up very well? And there's been a lot of talk about why that is, low inventories, those kind of dynamics.
Yeah, I think obviously the root of the problem is cost of capital, and specifically, debt cost of capital. I've never been in a period in my life where, and I'm an old guy, I've never been in a market or a cycle where interest rates have risen so rapidly. I don't think anybody was prepared for that. We knew interest rates were going to increase, and we were waiting for rates to rise. And finally, we get exactly what we've asked for. We get rates to increase, but so quickly. So that's impacted the balance sheets of a lot of real estate landlords. However, it's mostly in the private side that I'm most concerned about. James, before I began writing on Seeking Alpha, I was a real estate developer for over 25 years. And we took out loans, took out a lot of personal guarantees. I did a lot of bad deals. I did hopefully a few good deals. I got exposed to all types of property sectors. My favorite sector, of course, is the net lease sector. Think about Walgreens and CVS and Advance Auto Parts, those companies. That's who I built for. And I really like that sector. But again, going back to my career, I never witnessed a period where rates went up so quickly. And now we see the convergence of rate increases, but now the banks the banks have come in and really tightened the screws on lending. If I were a developer today, I would be extremely concerned about my business not being able to, access capital, especially when loans mature. So we're going to see a substantial wave of loan maturities throughout pretty much every property sector. James, I was just on the call 30 minutes ago with the CEO of Mid-America Apartment Communities, and I can't remember the exact number, but it was amazing to see how many loans are going to be maturing in the multifamily or apartment sector over the next 12 and 24 months. So I think now what we're seeing is this convergence of rates moving so quickly and debt maturities. Banks aren't in the market, but guess what? This is where the REITs are really becoming attractive right now, because most of the REITs, at least the companies that we cover and we recommend, these SWAN, Sleep Well at Night REITs, these are the blue chip companies that have fortress balance sheets. Those companies are going to be able to capitalize on this big problem that's beginning to surface now, which are these private developers. The private equity markets now, they basically are getting cut off because of the access to their capital costs. So it's making these REITs more and more and more attractive, especially those REITs that have access to capital and low cost capital today.
That's very interesting. You talk about these REITs having great opportunities. You've mentioned how they're more resilient and how we're going to get these troubles in the market. Do you think that will translate into the economy then? Do you see the economy kind of heading south in the next 12, 24 months as we see that weakening in real estate?
Well, again, it's hard to say. Again, I'm going back to that broad brush. It varies, sector by sector. Certainly like within the multifamily sector, we saw just an enormous run up in rents during in the pandemic. In the apartment that I rent down in West Palm Beach, the rent in my apartment went up 60%. And I had to renew the lease or find somewhere else. And there weren't many properties I could go to. I mean, so the landlords had significant pricing power in 2020 and 2021. Now it's calmed back down. It's basically moving back into kind of the normal, rental growth range. But yet the market has kind of, as always, the market either overshoots or undershoots. And now we're seeing, at least for these multifamily REITs, the market has undershot them. So we're seeing significant value in that sector. But again, you look at other sectors. Another place we really like is the data centers. They've also sold off quite a bit. And again, fundamentals are extremely strong. There's a lot of growth. The occupancy rates are getting better and better. And so, but you have to go to each sector. Not every sector we don't think as attractive as other sectors. Self-storage is another place where there's tremendous pricing power. Self-storage leases are basically monthly leases. So as a landlord, you can increase those rents much more rapidly than you can, say, with a long-term net lease. So again, I don't like every property sector, but we certainly look at all the property sectors to try to scrape the best value we can find within those sectors. I think the media headlines are going to continue because on the private side, you're going to continue to see the headlines. There are going to be apartment complexes that are foreclosed. Of course, we all know malls are foreclosing. There's more and more mall foreclosures. There's going to be a lot of office product hit the market with these debt maturities. And so those are the headline news, headlines that we're going to see. But again, going back to the REIT space, these REITs are extremely capitalized. Again, I just spoke with the CEO of Mid-America Apartment Communities just 30 minutes ago. He's got $1 billion of capacity right now to execute. So they are going to be cherry picking for opportunities over the next 12 and 24 months. And I'm happy to be an investor in that company, by the way. I do own Mid-America. But those are where those opportunities are going to be. Yes, there's going to be a lot of stress in the commercial real estate market, but you want to be equipped to take advantage of those situations. And those are the REITs that we really want to allocate capital to, that we know they can execute on a lot of this volatility.
Absolutely. That makes a lot of sense, especially as you said before, with an environment that's changing so quickly, opportunities are going to arise, and it's important for us investors to capitalize on those. Now, to wrap up this kind of macro conversation, I did want to talk a little bit about the recent Fed meeting. And of course, we got that Fed pause or skip, as they like to call it. Now, I guess the simple headline is, if the Fed is pausing and rates are going to go lower, perhaps that's good for REITs. What are your thoughts on the Fed policy and the outlook for interest rates?
Sure. Well, again, I would just say anybody who owns REITs, hang on. I was hoping, and I think everybody was hoping to see more of a lift, which obviously the number one catalyst is going to be a rate pause. And it's coming sooner or later. Obviously, this is the market's at least telling us, and actually Jerome Powell's telling us, not the market, this week, that we've got an additional increase, and I think he said increases, so probably one or two more. So I look at this maybe in the end of 23, maybe early 24. We will have that event where officially will be paused. Now, the big question mark, of course, is recession. And some argue we're in a recession. Some argue that we'll be moving into recession. Some argue that we're not going to have a recession. And we have all the job numbers that everybody loves to debate over. But at the end of the day, we're preparing our investments as if we are entering a mild recession. That's the way we're playing this right now. And so what that means is I'm not chasing I'm not putting capital in a lot of hotels right now. Hotels always underperform in mild recessions or great recessions. And so I think we look at these different property sectors and try to allocate capital around that, recognizing the biggest risk I think in the room right now is that potential recession and what happens to these various property sectors during a recession. There are some categories that are much more resilient in recession periods, and some aren't. So I think that's kind of how we're playing. And of course, as history shows us, during recession, rates do come down. So if I had to pull open my crystal ball right now for you, James, I would say we've got another rate increase, 25 basis points. We probably have maybe another increase, 25 basis points, and then we're going to have a pause. And then who knows? If that recession card comes into play, we're going to be prepared for it. And I think that's the best thing we can do. Is we advise our customers is just prepare for that recession. It may or may not come. We may be in one now. Perhaps we're in a blue collar recession now. I mean, we're looking at some of the data points like the rising credit card rates and the rising subprime industry rates, and so consumers are starting to be squeezed. And so we're looking very closely at that information to see exactly how is that going to translate into potential for recession. So it's an interesting time right now. But again, I think that the takeaway is, be a landlord where you've got, ability to capitalize on this market that we're in right now. And James, I just finished an article. I haven't published it yet. I'm going to publish it the next day or two. But this article, I went back, I took a couple of the very high quality REITs, and I went back all the way to 2008, 2009. I looked at those companies and their balance sheets back then and their earnings, and to see how they navigated the Great Recession. And most REITs cut their dividend in 2008, 2009. There was only maybe a dozen or more, right, maybe 13 or 14 that did. But I compared those companies, those blue chip REITs, to a current period. And companies like, for example, Realty Income had a triple B rating in 2009. Today, they've got an A- rating. So what is that? And their payout ratio was lower today, much lower today than it was in 2009. So what that tells me is this company is extremely well prepared to navigate this risk that's in front of us, which most likely is a recession risk that's looming.
Absolutely. That makes a lot of sense. And it's a point you've made already, talking about the swans. And I think I heard someone say once, the best investment you can make is one that allows you to sleep at night. And we do have that risk coming on. You talk about 2 rate hikes. I think that would surprise a lot of people. It's not unprecedented. We have seen, the Bank of England, I believe, go back to doing some rate hikes. So, like you say, there's definitely that risk there, and it's important to be prepared and have your investments aligned with that. Now, moving on from the macro, I would like to take things back to fundamentals. How do you think about rate investing? What do you see as a good rate, a bad rate? How do you go about just investing in rates? Just take us back to the basics.
Yeah. So, I think it really comes down to, again, you mentioned it, fundamentals. I mean, whether it's a, real estate stock or an ordinary stock. I mean, the main thing our team does is we focus on underlying fundamentals and earnings growth. Earnings is really the best indicator that we have in terms of how we value these companies. A company that can consistently increase their earnings and their dividends and grow their earnings and their dividends is going to be a successful company at some point. You've obviously got to buy those companies at a margin of safety. And that's really what we do. Is the simplicity of our business model is we focus on the quality of the business model, the quality of those earnings. And how do you define quality of earnings? Again, it goes down to their underlying, in the REIT space, and look at their underlying rent checks. So who is actually sending the rent checks in? What's the quality of that operator or that tenant? We look at the length of those leases, the ability of the pricing power, the ability of the landlord to increase those rental streams. And then we look at that underlying capital stack, how much debt, how much equity, preferreds. And then within their debt, how is their cost of capital on a debt side and on an equity side? So you take the sum of those parts, and the most important thing is to look at the return on invested capital. We want to see what that company is investing in and how accretive are those investments to the earning stream. And that's the key for us. When analyzing these companies, it's a lot of work. You have to really look under the hood and see exactly what's in there. And then once we analyze that company, we feel like we've got a really good grasp on the business model. Then we look at the management. And that's probably one thing that I do more than anybody else that I know is we spend an awful lot of time with management. I was on the phone today with 2 CEO interviews. I've got one later today. Alexandria came out with a big short yesterday. We're long Alexandria. And I'm really anxious to hear the CEO talk about this short of yesterday. And quite frankly, James, we've done pretty good with these shorts. I mean, I'll tell you, it's we've got some right now. Digital Realty's one that we're looking at. I just published an article on them recently. Of course, we've been covering medical property trust in great detail. But again, at the end of the day, we look at those, we study those companies in detail. We make sure we know all of those risks that are there, or at least try to understand the risks that are there. And it's been a pretty successful plan for us, and I'm really excited for our team. We've got now 8 different analysts working across all different sectors. All of us are income oriented. So whether it's a REIT, a BDC, MLP, or ordinary C corporation, we look for companies that grow that income. Income growth is really paramount to our business model.
Mm-hmm. That makes a lot of sense. And as someone who isn't so invested in REITs, I do like the appeal of, as you say, you can really get to know the business model and kind of systematize that idea of the cash flows, of course, and dividends. Did you mention that you are shorting some REITs? Did I hear that correctly?
No, I'm not. I'm defending, or I should say, debunking a couple of the shorts that are out there. And again, I'm not. Right. I will say this, because this is probably an important point. Is we try to look at all the short research. And some of it we find there may be some things that we miss that these other short sellers haven't, that we can be more informed that way. So we really try to analyze these companies and try to take an unbiased position of what are they saying. And, there's some good arguments out there that, and look, right now within the REIT sector, it's really kind of the perfect storm for the shorts, because you have, again, the high interest rates you've got that have been moved up so quickly. You've got a lot of volatility in the marketplace, and these headlines, that we're seeing. And again, most of those we're seeing are on the private side, but that's created that volatility, and the short sellers really love that volatility. So, but again, that volatility is really the opportunity. I really want to point out one we call pretty well is Arbor Realty Trust. Mm-hmm. We're up about 40% since the bottom of that short was called out. I interviewed, again, the CEO yesterday. We talked about it a little bit. They did buy back stock during that short report. That, as the CEO told me, they wanted to buy more than they could, but they were in a blackout period. But again, that's created a great opportunity for us. So, I really enjoy to look at these short articles. I think, if we really are bullish in the name, it's an opportunity for us to buy more shares or recommend to our readers or to our subscribers to buy more. So I think we do a lot of research in these companies, and I think that ultimately that pays off.
Mm-hmm. Absolutely, and I know a lot of investors nowadays are very interested in those what they call short squeezes. So maybe one of these REITs can be the next GameStop. Now, I'm very curious because you've mentioned you talked to a lot of CEOs, and of course the human element is very important with investing, something that is often overlooked. Has there ever been a situation where you analyzed a company, you felt that it was a very good company, and then you were kind of put off by the management? Feel free to say as much or as little as you want on this.
Yeah, no, that's a great point. I mean, look, I was telling somebody this morning, real estate's an interesting business. I mean, again, I've been doing this for 30 years, built a lot of buildings and created some pretty significant wealth in real estate. But I didn't do that through just the property. I did it through the people. Deals get done with people. Mm-hmm. That's at the end of the day, that's the people are what makes the property valuable. So we certainly think the people are important, and especially the people that are running these REITs. So again, that's why I spend an exhaustive amount of time meeting with these management teams. I have many CEOs on speed dial. That doesn't mean they'll take my call, but hopefully they'll call me back at some point. And but yeah, people are important, and you need to make sure that these management teams are aligned, with investors. So we obviously look at those things like having inside ownership. G&A is extremely important. We want to make sure that we're not overpaying this management team, and that they're executing on that business model. Again, at the end of the day, we want to see them grow earnings, and if they're not growing earnings, then we've got a problem, and we need to figure out how that what's wrong with that, what's wrong with this company. And again, there's a lot of companies that are constrained with their cost of capital. Again, these are the lower quality companies that are out there that have higher leverage. I mean, those are the companies that I'm really more concerned with, and I really try to advise investors to either stay away from those companies or recognize that they're highly speculative in nature. But I guess you're right. I mean, the people are really important, and we look at the board members. We want to make sure that there's diversity within the board, that the board is providing value and contributing. There was an article we just wrote on Digital Realty, and they've had some turnover, not only within their management organization, but also within their board. And we've talked to a lot of people about the company, and I think they needed some new, fresh management. We think it's very positive that they've created, a more rounded board. And so I think that's an important thing. We do spend an awful lot of time on the people part of it, not just the property part of it. But again, that's what pays off for us. And honestly, having these interviews, lots of times, James, I'll learn more from an interview, not only maybe specifically about that company, but maybe a competitor, or maybe it's just a broader, macroeconomic thing that I pick up that could help us with our recommendation. So I think it's not just that, with the questions I asked aren't just softballs. I try to go in and really go into the weeds of the company, but also see if there are some clues that are going to help us understand the company better and the motivations of that management team. So, again, that's become a really important part of our coverage spectrum. And, I call it the horse and the jockey. I mean, you want to be able, when you're investing in the company, you're betting on the company, you have to bet on both the jockey and the horse.
Mm-hmm. Absolutely. I have to say, it's great that you're in this privileged position where you can get to talk to these CEOs and really get that inside scoop in the company. Now, I wanted to go back to talking a bit about different sectors in the REIT space. You've mentioned a couple already: healthcare, you mentioned data centers. What are the kind of winners and losers you see? What are the sectors you're interested in? Others that you don't think will benefit so much in the coming years?
Yeah. So, so far this year, healthcare has done pretty well. Healthcare is up about 21% year to date. Single family rentals is also another sector that's been doing really well. Obviously, that there's been a catalyst here. Again, going back to the rising rate environment, that in effect has forced a lot of potential homeowners into becoming renters. And so that single family rental sector has done pretty well. Data centers are up this year. Again, they're still relatively cheap. There's only 2 data center REITs now that we call pure play data center REITs, Digital Realty and Equinix. There's Iron Mountain, which is not a pure play yet. They're moving closer to become more of a data center REIT. But unfortunately, we've lost 3 data center REITs. 2 went private, Cyrus One and QTS. They were both sold out to private equity firms. And then the third one was Coresight, and they got acquired by American Tower, which is really a tactical bolt-on acquisition for American Tower. So we like that sector, and the technology space is really interesting. So when we talk about real estate and technology, we primarily are talking about 3 different sectors: data centers, cell towers, and warehouses or logistics. Those are connected. We call them the technology trifecta. And so it's like 3 legs to the stool. They all work together. They all get goods purchased through e-commerce and get them shipped to the house. And so all of that, you can see that works together. Now, that's where you're going to see the growth. And that's where we've allocated more capital to all of those sectors because of that technology. What's really interesting too, James, I just finished my book, REITs for Dummies. I'll have that published this summer. And I actually decided to spend some time utilizing it, going more into the weeds on prop tech. The prop tech sector is really interesting. And as property and technology combined, even on this interview, for example, I just had with Mid-America's CEO this morning, he was talking about how his company is going to move the needle with the technology enhancements that this company, this REIT has, and they're actually going to be able to lower their G&A costs because they're utilizing more and more technology to run their business and make it more efficient. So I think the efficiencies we're seeing in technology and property is really amazing. And actually with the dummies, I don't know if you've ever seen a dummies book, but you can use icons. So we created our own prop tech icons. Every time I write about a prop tech within those categories, I will use it. So anyway, I like those technology plays. So data center, industrial, self-storage. Self-storage in itself is a prop tech business. I mean, we don't now find the self-storage properties from the yellow pages. We did that maybe 10 years ago, but now we utilize all of the online and all of the technology channels to really drive those businesses. So I guess some of the sectors that have really been beaten down, and I mentioned the office sector. I mean, we're down about 18% year to date. I'm really concerned about the gateway markets. I mean, San Francisco is just a mess. I was there speaking at a conference last year and just was really amazed at how bad it really is. I'm sure it's gotten worse since I was there. So we're kind of avoiding all of that New York, San Francisco type markets. We like the Sun Belt. Of course, you and I right now are both located in the Sun Belt. You're in Florida. I'm in South Carolina. And companies like Highwoods Property Trust is a really good example of a company that has a really strong exposure. By the way, Highwoods was the only REIT in 2008 and 9 that did not cut the only office REIT that did not cut the dividend. So there are certain categories within office. Cannabis has just been beaten down. Obviously, there's a lot of politics behind cannabis, and potentially recession could be a problem with cannabis. They're down about 16, 17% year to date. Cell towers are also down about 13% year to date. We like both of those companies, both American Tower and Crown Castle. Net lease sector is just good old steady Eddie, reliable dividend payers. Right now, again, they've sold off companies like Agree, which is very high quality net lease REIT, Realty Income, and Vici Properties. Those are all 3 very solid net lease REITs. There are some others, but again, I think that's a category we really like. I think there'll be some M&A in the net lease sector. There's way too many. I think there's 15 or 16 varieties or types of net lease REITs. So I think you'll see M&A. Again, I'm avoiding lodging. Malls is a decent space. The only mall player I really like is Simon. I wouldn't own anything else. The good thing is we called all of the Washington Prime, CBL, Pennsylvania REIT before the recession. We had sales on all of those, and hopefully we got some people out of trouble. So again, the great thing about REITs is we have all of these different categories, and we can model or build your portfolio around your own risk tolerance. And so that's really what's exciting about REITs.
Hmm. Absolutely. Yeah, it's great that they give you that flexibility. And you've talked a bit about tech and REITs, data centers. Of course, that's kind of the topic du jour today with this kind of big AI revolution. Is that something that we can play in REITs? Do you have any thoughts on how AI is affecting the REIT space?
Absolutely. I was at an investor conference last week in New York, and I met with the CEO of Digital Realty. Actually, he's a fairly new CEO, or his role is new to the company, Andy Power. And he talked about AI and actually wrote an article about this. And quoting him, an AI tide lifts all ships. And so AI is going to be it's the backbone for AI. Much like data centers, the backbone for crypto. My son is a big crypto NFT guy, and I don't know why, but he loves it, and that's fine. but I remind him that being a virtual landlord is not owning NFTs. Being a virtual landlord is owning a data center. And because without data centers, there would be no NFT, there would be no crypto, there would be no AI. Everything is stored in the cloud. And back to Digital Realty, because again, I'm very bullish this company right now. They've got a tremendous development pipeline of about $2 billion. They've got over 50% pre-leasing in certain markets that are 100% pre-leased. These hyperscalers, they go in and lease the whole entire building out. So that development pipeline is going to pay dividends way down the road for this company. So the question with Digital Realty goes back to their capital and make sure they've got plenty of capital, their dividends covered. And we've debunked all of that in our article. So you can go read that. I don't have to go onto your podcast doing this, but we like the data center space and the cell tower space. We think there's significant opportunity there. That's where your growth is. But right now you see value. And when you see a combination of growth and value, you really need to be looking at those companies.
Mm-hmm. Absolutely. That makes a lot of sense. Now, I'm curious to know, because you mentioned the cannabis sector. I recently had a fellow SA contributor on the podcast, Julian Lin. We talked a bit about the cannabis sector. That's the area where he specializes. And like you say, it's been beaten down. Do you see opportunities there?
Yeah, I do. And actually we called this pretty well. We had a dividend cut yesterday with AFC Gamma. We had a sell recommendation months and months ago. And of course, we knew this was coming. So they guess what? They cut their dividend. That's a mortgage REIT. They've actually are trying to pivot out of cannabis a little bit into some other sectors. We've met with the management team there, not very impressed. And we pointed that out. I will say, there's basically two or three players out there that most people are familiar with. Innovative Industrial. They were the first mover advantage. They're the only New York Stock Exchange listed cannabis REIT. They got in just before the election, I guess in 2016, and that allowed them to get in and kind of before the window closed for at least New York Stock Exchange listed companies. So they have one, I guess, I won't call it a competitive advantage. It's more of a strategic advantage they have because they have that New York Stock Exchange listing. They do have very high quality companies. And I will say the management team has done a pretty good job. There's been there's been several operator defaults in the sector. These aren't investment grade companies. And what I remind people is, look, when you're going to get a company that lends money out at a 12 and 13% coupon. In other words, any company that has to borrow at 11, 12, or 13%, that's a pretty high risk company, And so, Mr. Investor, you need to be prepared for the risk, with these companies. Just like I invested in another company called One Main Financial, which is a consumer credit company. They lend money out at 30 and 40 and maybe 50%. I don't know. They get around the usury laws, but I knew going in that One Main Financial was a higher risk company, it all comes down to managing defaults. You're going to have defaults. IRP, you're going to have defaults. One Main, you're going to have defaults. And by the way, Sachem Capital, which is another higher yielding mortgage REIT that lends to companies at 12, 13%, you're going to have defaults when you lend money out those kind of rates. So the real thing with being a landlord is how do you mitigate those losses are those defaults. And thus far, I will say, IAPR has done a pretty good job with that. They've been able to still continue to grow their earnings and their dividend. So we like that company. New Lake is kind of a smaller version of that. The only problem is they don't have the New York Stock Exchange listing. They have a NASDAQ listing. I would like to see those companies combine at some point. They should. But anyway, we'll leave that up to the management teams and those board of directors. The other one I like a lot, which a lot of people don't really know about, is called Chicago Atlantic. I don't know how they came up with the name. Mm-hmm. Interviewed that CEO quite a bit. I need to again. Their ticker symbol is called REFI, R-E-F-I, and they're a mortgage REIT, very similar to New Lake. They invest in some of the higher quality cannabis properties, and they've done a pretty good job as well. So I don't know. There may be a combination. I could see a combination. Maybe New Lake and REFI maybe could combine. New Lake would then move over from their over the counter. By the way, I think I said they were NASDAQ, so I want to back up. They're actually not NASDAQ. New Lake is over the counter, and REFI is NASDAQ. So I could see a potential merger of New Lake and REFI, but then New Lake would fall into that NASDAQ listing, which would give them a little more liquidity than they have now with the over-the-counter listing. So at any rate, that's kind of how I'd sum up the cannabis sector. It is a higher risk sector. There are defaults. The game is all about how you're going to mitigate those potential defaults and still continue to pay out dividends that aren't being cut.
Mm-hmm. It's interesting that you mentioned New Lake. That was the stock that Julian recommended. So happy that you mentioned that and that potential for that particular company. Now, I wanted to know a little bit more about how you go about investing in REITs, building a portfolio, and if you ever invest in REITs globally, because we've talked about, you've mentioned like different areas in the US that you're more interested or less interested in. Do you think about REITs globally, like in different countries, and do you invest in different geographies as well?
Great. Well, James, I don't want to, maybe it's time for a commercial. So I just mentioned my new book, The REITs for Dummies, and I dedicated an entire chapter to my book on global REIT investing. This book is actually going to have global exposure. My publisher Wiley has tentacles all over the world, and so really, I wrote this book to REIT dummies all over the world, and there are many. I'm still a REIT dummy, by the way, but I don't want to offend anybody. But that was really an interesting chapter to write, and looking at all the countries, we went into every country that has REIT-like laws. And it's significant. There's about 40 different countries, all the G7s. Canada is a real interesting place. There's a lot of Seeking Alpha readers and investors in Canada. An interesting point with the Canadian REITs is that most all of the Canadian REITs do pay monthly dividends. And digging into that, we found out that most of the institutional investors in Canada, they prefer the private market. They like doing their own deals and investing in the private side. I don't know why, but that's the case. So it's mostly a retail-centric market in Canada. So it makes sense that those REITs are paying out monthly dividends. So Canada is a really good market. Only about 10% of the market the size of the U.S., a much smaller market capitalization. Obviously, the U.S. is a dominant market. There are a number of REITs in Europe. We went in all those countries, France and Spain and Germany. And China is an interesting market. I don't know if you know this. This is another interesting point. The Chinese REITs, they're all single property REITs. So when you invest in a Chinese REIT, it's really still not regulated yet. But if you invest in a Chinese REIT, it's just one property. So there's no diversification. So they've got a long way to go in China. Japan is much more advanced in terms of their REIT model. And, it's been a fun chapter to write. Of course, for the individual investor, and we wrote about this in another chapter, James, on ETFs, because there's been an extremely high interest in REIT ETFs. So I don't know if you know this, but I have launched my own REIT ETF index, and we'll actually have the ETF hopefully in the market this summer, along with the book. But the reason you can invest in globally, I would recommend, is because there's no way that most investors on Seeking Alpha can really understand any of those markets and understand those properties and those people that run those companies. So I suggest a ETF, and Vanguard has a really good international ETF if you want to get exposure. Now, finally, a lot of the U.S. REITs invest outside of the U.S. Companies like Realty Income, for example, or Ventas, Mega Healthcare Investors, WP Carey, who I wrote on today. Hopefully that article's trending. But a number of these companies, they invest internationally. So you can get exposure, internationally without going outside into another ticker symbol and stay within the U.S.
Mm-hmm. Absolutely. Well, I'm looking forward to reading your book. And once I know a bit more, perhaps even dipping my feet into the Brad Thomas REIT ETF. Now, with that said, I wanted to also get a bit more of a sense of how you think about REIT investing within a portfolio and for different investors. I saw you had a fairly recent article talking about REITs you would buy in your 20s, I believe. So I'm just heading into my 30s and I'm looking at REITs and stuff. What would your advice be in terms of investing in REITs for different types of investors? Because I get the sense sometimes that REITs maybe are more for more retirement-focused investors, but I guess that's not necessarily the case, right?
Interesting. I just posted something on Twitter today. This is a Will Rogers quote. Don't wait to buy real estate. Buy real estate and wait. And that could obviously apply to REITs, right? And so, look, now's a good time. You're in your 30s. That's a great part of life, by the way. And great time of life. I've got 5 kids and a grandkid now who's 1 year old, and time flies. All I can tell you is you don't really think about it till you get older. And but look, start right now and start investing in REITs. And again, don't speculate. Obviously, when you're younger, just like with my son's 20 something. He can afford to take some losses. And I like it that he's investing in crypto and NFT because he's going to learn the difference between an investment and speculation. Frankly, I did too. I mean, I made some really stupid decisions. I didn't have an NFT back in my 20s, but I had some things that were very similar to NFTs. I invested in some land with no rent check and borrowed money, had to make big loan payments with no income coming in, and got to learn those lessons in life. So I would say put it on cruise control. Start if you invest in REITs. You're not only going to sleep well at night. You're going to make money while you're sleeping at night, and that's the great thing. But you've got to make sure that you understand those businesses and building out a diversified portfolio. Don't put all those eggs in one basket and just think, hey, I'm going to win big on this one company. Like Vici is in the gaming sector. I'm going to put everything in Vici because I own a bunch of casinos and I'm going to make it rich. Look, I mean, there's very few home run heroes here, right? And I think the way we look at it is you should allocate capital. Diversify is the key, and just start allocating capital, throughout these different sectors and build a blueprint. The first way to get started is build a portfolio out. And this is my blueprint, and then stick with that blueprint. The biggest thing I see with investors today, and I'm speaking to myself as well, is discipline. You've got to maintain discipline. Make sure every week allocate a certain amount of capital and put it into REITs, and then put it into utilities and put it into ordinary stocks, C corps and BDCs, and build that whatever your portfolio has. Be disciplined with that portfolio. Just like when I go to the gym every morning, I wake up at 5 o'clock. I spend an hour at the gym every day. I make myself do it. It's actually fun now. I mean, I really feel like it's fun because you start to see those dividends. And so, that's really my best advice is to and focus on quality. Don't try to market time. I know there's a lot of tempting companies you can see on Seeking Alpha that are yielding 12 and 13 and 14%. And I'll tell you, this high yield will get you in trouble. Just, stay disciplined, stay focused, and focus on quality companies with quality earnings.
Mm-hmm. I think that's great advice for anyone listening. And now, before we wrap up, you talked a little bit about your own past. I'd love to know a bit more about how you got started. I was looking at your Seeking Alpha profile. You do talk a bit about, making a good chunk of change, and then kind of going through that Great Recession, and then going on to build, such an impressive presence on the internet on Seeking Alpha. So I'd just love to know a little bit more about that.
Sure. So, I when I got out of college, I always wanted to get into real estate, and I thought about going to Wall Street. Actually, I thought about moving up to New York and getting a job as a stockbroker. But I always had that real estate blood in me. My grandfather, my mother, were all in real estate, and it was around me a lot. And that was a business I knew. And so I started as a developer. I went to work with the developer, and we became business partners. And the great thing about this first job I had was he owned a lot of land, and it exposed me to all types of real estate, just like in REITs. So I built shopping centers and warehouses, and my business partner even built a golf course and hotels. So I saw value creation from the ground up. I saw how to actually, take a raw piece of land and hire the right people and take that blueprint and build something that could create value and jobs and income. And I've always just been so fascinated with real estate. So that happened for about 20 years. I went through some cycles. There were some recessions I went through, and really unscathed. I think I picked some of the right categories to develop. I built a lot of freestanding properties. One of my main clients was Advance Auto Parts, which is essentially kind of a recession-proof company. So O'Reilly Auto Parts. I did have some deals that didn't work out. I mean, I built for Blockbuster Video. Fortunately, I got out before they ended. Much like my bearish article this week on EPR properties in the theater sector. I've lived through a similar cycle, and I think it's extremely been disruptive with the technology. I'm referring to Netflix, for example. So I try to learn from those experiences, and so when we were kind of in the 2005 and 6 area, my business partner decided to build a pretty large hotel, which was $40 or $50 million deal. Here in this town. It's about 5 miles down the road here. And I was not involved in that financially, but we were involved in quite a few partnerships. To fast forward that, he ended up he got it built, and he ended up losing the property and basically took the whole ship down with him, which was me. And a lot of others were impacted. And so a lot of my investments with him were ended up going to zero. And again, it goes back to that people and property. I mean, I've got this mantra that I like to use, and it's you can remember the ANB, avoid negative people. And I just now, I don't have to. I can be selective now, in what type of partnerships I get into, and what types of properties I buy, and what kind of REITs I'm going to buy. I'm just a lot more thoughtful to where I allocate capital, because when you lose capital and you go through these really adverse times, it really changes your life. And so this then the recession kind of piled it on, the Great Recession, which frankly led me to Seeking Alpha, because at the time, again, I was in real estate and really had to start all over again. Five young kids at the time. And so I landed on Seeking Alpha, and it's been a great platform, and it continues to be a great platform. I'm really honored to have more followers than anybody on Seeking Alpha, and I've worked hard for that role, and it's a great place to contribute, and I love interacting with other people and helping other people, and they help me as well. I've got this saying, the most durable education is self-education. So I've learned a lot with other people. Hopefully other people have learned a lot from me. And I'm happy to be the author of the REIT for Dummies book. I'm really excited to get this book out, and hopefully everybody on Seeking Alpha will get a copy of it. And, but it's been a great story. It's been a great run. And, I'm looking forward to another 10 years of work here.
Absolutely. Well, Brad, I can't thank you enough for coming on the show. Like I told you before, you're a real institution in Seeking Alpha. It wouldn't be an exaggeration to say that your face is oftentimes one of the first that I see when I wake up in the morning as I browse through the Seeking Alpha landing page. So again, thank you so much for coming on, and I really hope we can do this again sometime.
Likewise, it's good to see you, and have a great weekend, and happy to be back on again.
All right. Bye-bye, everyone. Thanks again, Brad.
Thank you.
Once again, everyone, thanks for listening to The Pragmatic Investor. If you aren't already, please go ahead and follow me on YouTube, Spotify, or wherever it is that you're listening to the podcast. And remember that if you'd like more content on investing, I do a lot more on Seeking Alpha. You can find me there, James Ford, the Pragmatic Investor, where I cover crypto, the macro outlook, international stocks, and so much more.